Hello, my name is Carole Foos. I'm a principal with OJM Group. I'd like to thank you for joining our webinar today on Tax Day Tips, Planning Now for April 2017. You'll see a disclaimer on the screen. Just realize that this is not personalized tax advice for you, and anything we discuss today should be discussed with your own professional advisor before going forward on any of the strategies. We do appreciate you joining us today, and as a thank you for joining us, we do have an offer of free books for anyone attending this webinar. You'll see the books on the screen, which have been written by the principals of OJM Group, and we'll talk to you at the end of the presentation about how you can get one of these books. So I'm sure many of you have recently filed your 2015 tax returns, and maybe you had an unpleasant surprise from your CPA when it was time to file, because certainly a lot of you are now facing 50% plus marginal income tax rates, meaning that you're working for the government essentially through June before you start working to put money into your own pocket. Total taxes on long-term capital gains and dividends can now reach as much as 23 to 35% when including the surtax under the Affordable Care Act as well as state taxes. So what we want to talk to you about today is making sure that you're not waiting until December to work on saving taxes for 2016. This is a great time for you to look at your 2015 tax return and talk to your advisors now about what you might be able to do to maximize your tax savings. And we're going to give you a few ideas on today. First and foremost, you want to think about what you might be able to do to reduce your taxable income. So one of the things you can think about this year is considering a Roth conversion. And while this might not reduce your taxable income for 2016, it does have the potential for reducing your taxable income in future years. You know, it's one thing to consider that if all of your retirement savings are going into qualified plans such as 401ks or 403bs or into traditional IRAs, all of that money is going to be taxed when you start taking distributions in retirement. So it might make sense to look at converting some of your traditional IRAs to a Roth this year. Certainly it makes some sense if your income is going to be down this year, or if you've got losses to realize from maybe the sale of a business or the sale of something else. If you've got some losses that would push your income down below that highest tax rate, it might be a great year to consider a Roth conversion. And you do have the ability, once you convert a Roth to recharacterize it if, for instance, the market goes down or you find that you didn't really have that room in the income tax brackets to make the change. One thing to consider as you're doing Roth conversion is potentially to make the conversion into separate Roth accounts by separating your asset classes, as that way it can make for an easier recharacterization of partial amounts of that Roth conversion. Another thing that this is a great time to be thinking about is funding your qualified retirement plan. You know, if you haven't looked at your qualified retirement plan recently, it's a great time to just revisit that and see if there's a way for you to get more money into that qualified retirement plan, or to reduce the cost of covering your employees, and doing a cost-benefit analysis of what you can get in versus what it's going to cost you to cover your employees. So just keep in mind that Safe Harbor 401k plans do have to be established by October 1st of this year. Non-Safe Harbor plans can be established as late as December 31st. But you do need time for deferrals to get that money in via the last payroll of the year. One thing that many of you might not know, if you own your business, you could rent your second home to your business for under 2 weeks for corporate meetings And as long as you've got rental income that is less than 2 weeks in duration, you don't have to report the rental income on your tax return. So again, if you've got an executive team meeting or a board meeting and you can use your second home for that, have the corporation pay you a reasonable rate of rent, that might be a way to get some expenses in the business and not have to realize taxable income on your personal tax return. It's also important right now at this time of year to make sure that you're utilizing an efficient compensation structure if your business is taxed as an S corporation. What do I mean by this? Well, you want to take advantage of paying yourself a reasonable rate of wages out of the S corporation, but also realizing profits from the work of others in the S corporation via S corporation distributions, which are not subject to Medicare taxes. If you've got losses in your business that you have not realized, take a look at whether you can realize those losses this year in order to decrease your taxable income. In addition, it's a good time to be thinking about charitable contribution planning. If you've got a favorite charity, it might be the year for you to create a charitable foundation or a charitable trust in order to get a bump in your charitable deductions. And also, think about accelerating your deductions this year. Prepaying things such as state income taxes and real estate taxes by year end can get those deductions into 2016 where you can take advantage of them. But be aware of the alternative minimum tax impact before doing this, as it might not be beneficial if you're subject to the AMT. One of the things we at OJM talk to our clients about is tax diversification. The 3 buckets on the screen represent different ways that assets may be taxed. Your assets, as I mentioned earlier, that are inside your qualified plan will be taxed at ordinary income tax rates when you pull those out. So in the example, if you've got 39.6% federal tax plus a 6.6% state tax and 3.8% Affordable Care Act tax, you're at a 50% tax on those assets. So your $100,000 withdrawal from your IRA in retirement is really only going to net you $50,000. The orange bucket shows your other investments, which are more likely to be taxed at capital gains and qualified dividend rates in retirement. So that same $100,000 deduction can net you $69,600 in that situation. And also make sure you've got some assets in that blue bucket, which is overlooked assets. Things such as Roth IRAs, which we discussed, or a life insurance retirement plan are generally tax-free in retirement. It's a great thing to look at now as a way to build your wealth tax efficiently for the future. It's also important to make sure that you're investing with a tax focus. Make sure your portfolio is tax efficient, meaning your income or assets might be better off in your qualified plan where the income on those assets is not taxed currently, it's deferred, and have your growth assets and tax-exempt assets in your taxable brokerage account. Make sure that you're timing the disposition of your assets so that they receive long-term capital gain treatment versus short-term capital gain treatment, as this can save you close to 20% federal taxes. Also, you probably hear a lot about harvesting capital losses against capital gains. Don't just wait until December to do this. Make sure that's being done all year long. But do be aware of wash sale rules if you invest in the same asset within a 30-day period. If you've got unused passive losses, you can consider investment strategies that create passive income. And take advantage of Section 529 plans for college funding. If your investment advisor isn't talking to you about making sure that you're thinking about taxes as a part of your investment portfolio, then it might be time to talk to somebody else, but certainly you've got to be aware of the tax impact of your investment decisions. Corporate structure planning can also be key in reducing your tax liability for next year. For instance, if you are a single member limited liability company, maybe consider converting to an S corporation in 2016. As I mentioned, active shareholders receiving reasonable compensation aren't subject to the self-employment tax on pass-through distributed or undistributed income. Make sure in that corporate structure that you're maximizing all types of benefit plans, fringe benefit plans, Section 162 bonus plans, and even non-qualified plans. And it might make sense for you to consider multiple entity structures for tax planning and for asset protection purposes. So take a look at your 2015 tax returns, review them with your advisor, think about your compensation and the Medicare tax you're paying. Is it as efficient as it can be? Look at your investment income and how it's taxed. Consider your qualified plan deductions, and then take a look at your itemized deductions and your alternative minimum tax. On the screen now, you'll see how OJM works with our clients. We have experts in all sorts of areas. So today I've talked to you about tax. We have other experts in areas such as asset protection, benefit planning, retirement planning, insurance, and investment advisors who consult with our clients on their wealth management. We're a fee-based consulting firm with 1,000 clients in 48 states. We have professionals in many disciplines, as I just mentioned. We do both corporate and personal planning for our clients. And we do have a firm commitment for qualified clients that if you don't receive at least 200% of your planning fee in savings, we'll return the fee. Next steps for you today, as I mentioned at the beginning, you can get a free copy of one of our books, For Doctors Only, or Fortune Building for Business Owners and Entrepreneurs, or one of the other books that we referenced earlier in the presentation. To do this, you can visit our bookstore at www.ojmbookstore.com, and you'll see the promotional code on your screen. We do have those books in hard copy or ebooks for Kindle or iPad. We'd also like to offer you a free consultation as a thanks for participating in the webinar. You can contact me. You'll see the contact information on the screen to set up that free consultation. Thanks again for joining us today.